I want to talk about the best markets that you can use to trade stock and options. I love to trade options. It's my core focus here in my own trading. It's what I focus on with our traders here at NetPicks as well. And the common question that comes up, and it came up here in the chat here just a few moments ago, Paul asking, do we perform a pre-market scan in order to identify the best stocks to trade? That is one way of taking what Shane just talked about and applying it, looking for candidates, but we like to take a different approach. I like to focus in on a core group of names that I get to know really well, names that I look at every day, every week. And that repetition allows me to trade with much more confidence. So how do we identify the superstar option stocks each week? How do I narrow that list down to a very manageable number of names? We're going to spend the next few moments talking through how to set up your watch list. How do you identify the names that you want to trade for 2021? Now, this year was a phenomenal year. I mean, news-wise, the markets were all over the map. Mark touched on it here when we started the webinar. It makes it challenging because when you get into a news cycle, you get new hot names in the news all the time. You turn on CNBC, Bloomberg, Fox Business, and you hear about these new IPOs and these new stocks coming to market, and they become very active for a stretch. You see these unbelievable moves, these news-driven events that cause these big price moves and then can typically lead to choppy, indecisive price action. So it's very easy to get caught up in that excitement and caught up into chasing those moves. What we would rather do is focus in on a small list of stocks. Now, what does that mean? What does a small number look like? That could be 10 stocks for some people. It could be 50 stocks for others. It depends on your account size. It depends on the amount of time that you're looking to spend focused on markets on a daily basis. So what we want to do is we want to master how these names move, and I'll talk you through how to determine the number of names on your list and what names make it to your list in just a few moments. Now, when I talk about mastering how these names move, it doesn't mean that I'm looking for perfection. I'm not looking to identify all the winners and miss out on the losers, right? There's no perfect formula out there for that type of an approach. What I'm looking at here is what is the winning percentage over time? If you pull up a watch list of products, go back and do a back test, even if it's only the past couple of months, take a look at all of the trades that meet your system criteria. Even if it's the approach that Shane just taught you over the past 20 minutes, go back and take a look at all occurrences over the past X number of months. See what the winning percentage has looked like. Are you getting a positive winning percentage? How long does a typical trade take? That's very crucial for us as options traders. I want to know, am I looking to take trades for 2 days, 2 weeks, 2 months? Looking back at historical price action does not guarantee that those stocks are going to follow the same patterns going forward, but it does give us a very predictable range as far as holding times go on each trade. I'm also looking for how liquid the options are. You can have the best looking chart pattern in the world, but if you're looking to trade that stock with options and the options aren't liquid, you're going to run into issues. It's going to make it more difficult to get in and out of trades quickly and at good pricing. So you want to take a look at the volume and open interest. I'll give you some numbers to use for determining whether those options are liquid or not. And then we want to focus on taking trades from your watch list. Once you establish that list in place, it's really important to ignore all of the noise from the other stocks. You're going to have distractions pop up. You pay attention to financial media and you're going to hear about new hot names all the time. You want to ignore that. I'm not looking to capture every big move in the market. I'm looking at mastering the small list of names on my watch list, because I know if I do that, there's going to be plenty of profit to be made over time. Now, there's a few mistakes that going through this process, a few mistakes that you absolutely want to avoid. A bigger watch list does not mean bigger profits. I hear this all the time. I got an email last night from a student asking, Mike, I want to make more money in 2021. Can I expand my watch list? Can I look at a larger number of products? That doesn't necessarily mean you're going to make more money. In fact, in many cases, you take that approach and it's going to lead to worse results because you get stretched too thin. You start to take a look at too many markets and it's easy to make mistakes. I would rather have you diversify with different types of trades, right? And expand your position sizing. That's going to allow you to become more active rather than just adding in a dozen new names to your watch list. Don't overweight one area of the market. This is so crucial. I mean, you take a look at what the market has done over the past 12 months. We have seen certain sectors outperform for stretches of time. They pass the baton on to the next sector, and you continue to get this rotation on a consistent basis. The tech sector has been absolutely on fire here for the last year, right? I mean, a lot of the tech stocks are up near their all-time highs. Very easy to say, I'm only going to trade the tech names and ignore everything else going on around us. The problem there is, what if we see another round of rotation going into next year? What if we see the tech names start to settle into more of a range-bound environment, and then you start to see the financials, you start to see the energy names pick up? The diversification, it makes a huge difference, not only with the products that you trade, that's a big part of it, but also with the options strategies that you're going to use. I'll talk about that more in just a moment as well. And then don't let the outcome of one trade prevent you from taking the next trade. You're going to have winners, losers, and break-evens. I don't care what system you're using. I don't care what market you're looking at. You're going to have winners and losers over time. Controlling that risk, making sure that the outcome of one trade or the outcome of 2 or 3 trades does not impact whether you can take the next trade, that's crucial. You want to keep the risk small. Ideally, we want that risk in that 2 to 5% of your account size per trade. That's the range that we ideally want you to be in, because now if you have a losing trade, yeah, no one likes to lose money, but it's not going to wipe your account out. The key is making sure you get your sample set of trades big enough over time. So how do we find our hot list? How do we establish the watch list of products that we're looking for? Well, the liquid options, top of my list. I trade exclusively with options. So again, you can have the greatest looking chart pattern in the world, but if those options aren't liquid, I can't trade that product. When I talk about liquidity, I am talking about products that have good volume and open interest. Out of those two, is one more important than the other? The open interest to me is more important. Volume, yes, I want to see good volume as well, but the open interest gives me a better feel for how active those options have been since they started trading. The volume can be a little bit misleading because you might have one headline hit and causes volume to explode for one given session, and then settle back down in the coming days. The open interest gives you a better feel for how active those options have been over the past weeks, potentially even months. A volatility, I'm looking for products that have a history of good movement back and forth. I am not looking for a stock that has a big news event come out, makes a big move, and then settles into a range and gets choppy for 3 months. That does me no good. I'm looking for names like Apple and Facebook and some of the index products, names that don't like to stay quiet for long. If you load up a chart of Apple, you start to take a look at the past couple of years of price action, you don't see very many stretches where price action doesn't do much. It's a very active stock. I want to be active with that product. Diversification, I've already touched on it, but just to quickly cover it again, I want to establish a broad list of stocks and ETFs that cover a number of different sectors. It's so easy to get caught up in one area of the market, one small group of individual stocks, that you miss out on some of the other great areas like the ETFs. I personally love the ETFs. They provide instant diversification. They give me exposure to different sectors or different areas of the world, and the options are far less expensive. The problem with the move to the upside over the past 8 to 10 months, I mean, the move off of the lows going back into March, the problem with that is a lot of these individual stocks are incredibly overbought. They're expensive. The options are expensive. You load up the options on Amazon or Tesla, Netflix, they're pricey. The ETFs, on the other hand, allow me to stay active with far less capital. If you want to trade Amazon, for example, you load up those options and you're talking about thousands of dollars of capital, it might not be doable depending on your account size. Well, there are ETFs out there like QQQ or XLY. They're heavily influenced by what Amazon does, and they're going to allow you to participate in that movement on Amazon, utilizing an ETF that's going to tie up far less capital. So make sure you mix up your watch list with stocks and ETFs. Very, very important. So what you want to do first is talk through and determine how many names you can afford to have on your list. If you've got a $5,000 account, it does you no good to load up a watch list of 50 products. You're not going to be able to trade all of those names. You're going to be left picking and choosing which trades look best to you, and that's going to lead to more inconsistency than anything. I'd rather have you focus in on a list of 12 to 15 stocks and trade those stocks consistently. That way you're not jumping all over the place. If you got the bigger account size, sure, we can certainly load up a bigger watch list to fit your account size. You also want to take into account how much time do you have each day to check the charts. I hear about this issue all the time. People that want to stay active in the markets, but they're busy working. They have family commitments, other commitments outside of the markets that prevent them from looking at the charts for an extended stretch. If you only have 20 minutes a day to look at the markets, you want to take a look at a smaller list of products. Don't try to look at 50, 75 charts. You're not going to be able to do it. You're going to get frustrated because you're going to miss things. You can make a really great return even with a small watch list of products. You want to take into account if all of those trades print setups at the same time, can you afford the risk by taking all of those trades? You want to try to prevent yourself from cherry picking those trades as much as possible. That's when it gets more difficult to produce the consistent returns. And then you want to go through and test all of your names. See how much it would take to take all of those trades if they set up at the same time. Back testing is often the overlooked step for most traders because people get attracted to the markets, they get attracted to the profit potential, and they want those instant returns. Trading is just like a business, guys. I mean, I wish I could tell you it's as easy as just flipping a switch. It takes work, it takes effort. You want to get to know the markets on your list. When I say do a back test, you want to go back, take a look at what the last couple of months have produced on those stocks. See the wins versus the losses. See the overall winning percentage, the average holding time. Having that data is going to make a huge difference in how you trade going forward. It takes work, but it can pay off in a big way with better returns over time. There are a few areas as you start to establish your watch list, there's a few areas that we highly recommend you have access to: the financial sector, the energy sector, the index products, the tech sector, and some of the global ETFs. Now, this isn't the end all, right? I mean, this isn't just the perfect list. These are just the names that you want to have access to. You can certainly add to it. You can certainly add other sectors, other areas to the mix, but these are the names that tend to lead markets in both directions, both to the upside and to the downside. If we start to see some selling in 2021, you want to have a mix of sectors and mix of markets available on your list. Now, we just got done talking through establishing that watch list of products. Now, I want to talk through 5 stocks that will improve your trading in 2021. Right now, when you look at that statement, a lot of you are probably thinking, "Oh, Mike's found some new names that I haven't considered before." Take a look at the 5 stocks that I want to point out. We've got Tesla, Apple, Roku, JP Morgan, and IWM, which is the Russell 2000 ETF. Nothing earth-shattering here, right? These are very common names. Why is that? I just got done talking about looking at names that have a historic track record of good movement, have a track record of liquid options. All of these 5 names meet that bill. These are all names that have been very active over the past 12 months, and we fully expect them to remain active in 2021. If all you did was trade these 5 names, I firmly believe there are big profits to be made next year. Ultimately, I want you to have a little bit more diversification. But the reason I point out these 5 stocks, they hit each of the bullet points that we look for. They all are very active. They have liquid options. They allow us to use a variety of different strategies, both weekly and monthly options, both long calls and long puts, and vertical spreads. Why did I select these 5? Tesla got added to the S&P 500 here over the past few weeks. That changes the ball game. It brings in a whole new group of traders and investors that maybe have never traded Tesla before. Tesla's also a very news-driven stock. I expect it to remain very active in 2021. It's one of the best products to trade with options at the moment. It's been so for the last year, and I expect that to remain in the top spot going into 2021. Apple had the stock split last year, which made it more tradable for a lot of retail traders. Seeing that stock split makes the options more reasonably priced, regardless of your account size. Apple is one of the most liquid products in the world on a daily basis. You can take any type of trade you want and get filled almost immediately on Apple. It's a very, very liquid product. Roku, right? Mark touched on it earlier, how the pandemic has changed a lot of things worldwide. One of those being people are stuck at home. They're changing how they consume entertainment. They're changing how they consume content. And Roku has been one of the benefactors of the pandemic because people are stuck at home. They are watching more TV. They are looking at things on Roku, Apple TV. I mean, they're very, very popular, and I don't see that changing anytime soon. I wish I could tell you I could see an end in sight for the pandemic, but yeah, I don't think any of us know when things will get back to some sense of normalcy. So you want to have access to those names that are going to thrive in periods of uncertainty that the pandemic is bringing us. JP Morgan, I often tell our traders it's very difficult for the market to make a move without the financials participating. They don't necessarily need to lead, but they do need to participate. And JP Morgan, for me, is the best of breed. It's that financial stock that's pretty liquid. It has consistent movement on a regular basis. It gives us the flexibility to use a variety of different strategies. You can trade Bank of America, you could trade Citigroup, but for me, the top financial name that I like to trade is JP Morgan. And then IWM. This is the Russell 2000 ETF. It tracks the small caps. The small caps have had an incredible run. Over the past 6 months, they have moved up to the all-time highs. It's been one of the most active areas of the market now for months, and I don't see that changing going into next year. Out of all of the index ETFs, IWM is the one that I think presents the best opportunity next year. I love to trade the S&P 500 ETF. I love to trade the NASDAQ ETF as well, but I think the small caps, IWM presents the biggest opportunity. I do believe you'll want to have it on your list for next year. Now, again, you can trade those 5 stocks and ignore everything else going on around you, and you'll see some pretty good results. But what if you want to be more active? What do you want if you want that additional diversification? What I did is I put together a list of individual stocks. These are stocks that I have done the research on. These are stocks that I have traded now for an extended stretch. I know they meet our criteria. I'm not saying you have to trade all of these stocks, but when you start to go in and establish a watch list that fits your account size, maybe you're looking for 20 stocks, here's a great starting point. Okay, you can certainly pare this list down. You'll notice we've got multiple tech stocks on the list. We've got multiple financial stocks, multiple energy stocks. You can certainly pare it down, really customize that list to fit your account size and fit the amount of time that you have to look at the markets on a daily basis. Now, don't worry about writing all these names down. We'll certainly get you the slides so you can have access to this list. I also put a list together of the ETFs that we like to trade. I love the exchange traded funds. Unfortunately, a lot of traders ignore them because they don't think they're active enough. They're not volatile enough. The ETFs are some of my favorite markets to trade. They're just such great products to get diversification with. You want to have, I would say, at least a third to a half of your watch list should be ETFs. So keep that in mind when you're establishing what products you want to look at. Again, not expecting you to trade all of these, but these are all names that we have traded in the past, names that we have had good success with, names that meet all of the criteria that we look for. Now, if we have that watch list in place, we've talked about some chart patterns to look at. Shane did a great job of that. Now we're talking through some of the best stocks and ETFs to look at on a regular basis. If you want to take these trades with options, what are the best strategies to consider? So many people get stuck looking at the long calls and long puts only. That's great. It's the most basic approach that you can take. It's a high risk, high reward approach. You only have one way of making money on those trades. If you buy a call option, the only way you make money is if that stock moves higher and it does so quickly. If it takes too long or if the move's not big enough, you're in trouble. I don't have a problem buying calls and puts as long as it's only one tool in your toolbox. There's also other strategies out there like the vertical spreads that are going to give you a higher probability of success. They're going to give you multiple ways of making money on the position. If you use a credit spread, for example, I love to use credit spreads. They're a very safe trade type. A lot of times people think they're advanced and they come with massive amounts of risk. They don't. They're actually safer than just buying outright calls and puts. And they give us 5 ways of making money on the trades. It's a more forgiving trade. We don't need as much to go in our favor. We don't have to have as many things to line up in our favor to make money. It's just another tool that we can have in our toolbox. And best of all, the vertical spreads will reduce the cost of those trades by 30 to 60%. Now, all of a sudden, trading Amazon might be more doable. If you can cut the cost by 60%, maybe you can trade Amazon. The long options, they're going to provide a lower probability of success, but a higher potential return. The credit spreads are going to give you a higher probability of success, but a lower potential return. So there's trade-offs with both. There's not a perfect strategy. I'm not trying to push you into one camp or the other. The ideal scenario is to use a mix of strategies. And here's how we do it. I've put together just a simple strategy playbook based on your outlook, covering the strategies that we like to use. If you are strongly bullish, buying individual calls, the most aggressive route to go, they're going to give you the highest profit potential, but they're going to give you the lowest probability of success. Not necessarily a bad thing. You just have to know that it's a pretty aggressive approach. If you want to be slightly more conservative, you still want to lean bullish, but you want to tie up less capital, the long call spread is the best route to go. You're going to get that 30 to 60% cost savings. You're still going to have a bullish trade. It's just going to be a slower mover. Just a way to be a little bit more conservative on the position. And then third on the list is selling an out of the money put spread. Using that credit spread, ideally you want to do it in a period of higher volatility. It's not required, it's just ideal. The short put spread is going to give you the most forgiving trade. It's going to have the highest probability of success, but it's also going to have the lowest profit potential. If you're moderately bullish, you look at this market and you say, okay, it's very clear the trend has been to the upside here. It's been that way for months now, but now we're extended. We're definitely overbought in many areas. What if you want to lean bullish in a little bit more conservative way? The debit spread, the long call spread, certainly the safer route to go. You can still lean bullish with less risk. The short put spread, using that credit spread, hands down a safer way to go. I use a lot of credit spreads right now, just due to the time of year. Right? We've got the holidays, we've got the lower volume movement right now. It's going to be that way until next week. The credit spreads allow us to put the time decay in our favor. Love to use the credit spreads. On the flip side, if you are bearish, we can still use the long puts. It's just an aggressive route. It's the most aggressive trade that you can take. Even though people think it's the safest route to go, it's actually the most aggressive. You only have one way of making money, and that's if the stock moves to the downside. If you want to be a little bit more conservative, the long put spread, better way to go there because you'll get that 30 to 60% cost savings. And then if you sell an out of the money call spread, the ideal scenario, especially if you're in a period of higher volatility, the credit spread will give you 5 ways of making money on the positions. The spreads, both the debit spreads and the credit spreads, are going to allow you to lean moderately bearish if that fits your outlook. So it really just depends on what you expect out of the market as a whole, but also what you expect out of the individual stock on your list. We just got done talking about how we want to focus in on a small watch list of products that we get to know really well. Here's the benefit of that. It's very easy to come in and establish whether you want to be aggressive or conservative, bullish or bearish. There's many ways that you can do that through the use of different option strategies. You can also just take a look at volatility. If you're in a high volatility environment, we've had a high VIX now for months. Going back to March, the volatility in this market has been high. When the volatility is high, options become more expensive. That is ideal for selling credit spreads. There's no rule that says you can't buy calls and puts in a period of high volatility. You can, they're just more expensive. Okay, you need more to go right in your favor to make money with that type of an approach. In a period of low volatility, options become cheaper. That's ideal for buying long calls, long puts. Again, there's no market rule that says you can't use a credit spread in low volatility. You just don't have as many factors lining up in your favor. So ideally, you want a mix of both. In my opinion, it should be everybody's goal. If you're not already trading vertical spreads, you want to add those vertical spreads to your trading toolbox as quickly